Okay, let's get right into it. It's the question on literally everyone's mind right now, from investors to engineers. This insane, world changing explosion in AI, is it for real? Or are we all just riding a massive wave that's about to crash? So, that's the big question we're tackling in this explainer. Are we in an AI bubble that's about to pop? We're going to dig into the evidence, look at both sides of the argument, and try to figure out what's really going on. And believe me, the stakes are absolutely enormous. And when I say enormous, I mean it. Just look at this number. We're talking about $47.3 billion poured into private AI companies in a single quarter. That is a staggering amount of cash moving at lightning speed. And that, right there, is the kind of thing that gets people shouting bubble. But before we jump to conclusions, we have to be on the same page. What even is a bubble, anyway? Right. And here is the most important part you need to remember. Disconnected from fundamental value. See, a bubble isn't just when prices go up fast. It's when those prices get totally unhooked from reality. It's all about the story, the hype, the momentum, while the actual tangible value of the thing gets left in the dust. It's excitement feeding on more excitement, a self-reinforcing loop. And, we've seen this movie before, right? This isn't our first rodeo. History is just littered with these things. You had the railway mania back in the 1840s, the dot-com boom that changed everything in the late 90s, the housing market in the mid-2000s. Each one was ignited by a transformative new technology or idea, and each one eventually saw a pretty dramatic pop. So the big question is, does AI just fit the pattern? So let's start there. Let's make the case for a bubble. What are the big, flashing red flags that suggest we're in one right now? Well, for one thing, the official watchdogs are getting nervous. When you see huge institutions like the Bank of England using words like frothy, well, that's their very polite, very British way of saying things are getting a little crazy. It's a clear signal that the people whose entire job is to prevent financial meltdowns are starting to worry. They're looking at these sky-high company valuations and asking, okay, but where are the profits? And this chart right here shows a huge reason for that worry: concentration. So much of the entire AI boom is basically riding on the shoulders of just a handful of companies, especially NVIDIA, who make these essential chips. When the market puts all its chips, so to speak, on one company, the entire system becomes incredibly fragile. Any little hiccup, a competitor catching up, a slowdown in orders could send shockwaves through the entire ecosystem. You can also see how AI has become this financial black hole for venture capital. Over half of all the money that VCs in the US are investing, the money that's supposed to be funding the future, is going into this one single sector. That kind of focus is a classic sign of an overheated market. It's pure FOMO, the fear of missing out, and it's pushing sober, careful analysis to the side. Okay, so that's a pretty strong case for a bubble, right? But hold on, that's only one side of the coin. Now let's flip it over and look at the counter-argument, why this time, just maybe, is actually different. Everyone loves to compare this to the dot-com bubble, and it's a fascinating comparison. Back then, companies were being valued on, what, clicks? Eyeballs? It was all pretty virtual. Today's AI boom, though, is built on something very real and very, very expensive: hardware. We're talking about GPUs, massive data centers, complex power systems. You can actually touch this stuff. And the scale of this physical spending is just staggering. $185 billion. That's the estimated capital expenditure just this year. This isn't just code, this is concrete, silicon, and steel. And that massive real-world investment provides an anchor for these valuations that just didn't exist for a lot of those dot-com companies. Which brings us to what some people call the good bubble theory. Think about it. The dot-com crash was painful for sure, but what did it leave behind? A massive surplus of now cheap fiber optic cable that have been laid all over the world. That infrastructure is what made today's internet, streaming, the cloud, all of it possible. So the argument here is that even if the AI boom deflates, it's going to leave behind a legacy of unbelievable computing power that will fuel the next wave of innovation. So we've got strong arguments for and against a bubble. But let's say a correction does happen. What would that actually look like? How would the dominoes fall? A downturn probably wouldn't happen all at once. It would almost certainly be a cascade, a chain reaction. It could start right at the bottom of the stack, with the chip makers. If demand slows down, you suddenly have an oversupply and chip prices drop. That domino hits the next one, the big cloud companies who bought all those expensive chips and now can't rent them out. That in turn squeezes the AI model labs. And finally, at the very top, all those cool little application startups, their funding just evaporates. It's a chain reaction from the bottom all the way to the top. All right, we've looked at the red flags, we've looked at the solid ground. So where does that leave us? After all that, what's the verdict? The most balanced take here probably isn't a simple yes or no. The evidence really suggests this is less of a purely speculative, hype-driven bubble, and more of a massive hardware-anchored investment cycle that's now in its later stages. And here's the key. That means the risk of a valuation correction is very, very real. But the underlying technological revolution, that's also very, very real. So if you want to keep tabs on this yourself, what should you be watching? Well, keep an eye on enterprise ROI. Are big companies actually making money from their AI projects? Also, watch the chip order books versus what's actually getting shipped. Is a big gap opening up? And finally, look at venture debt. When you see startups taking out loans instead of getting equity funding, it's a huge sign that financial stress is building just below the surface. These are your canaries in the coal mine. And based on how these things usually play out, there are two key windows of risk to circle on your calendar. The first one is coming up fast, from late this year into the middle of 2026. This is when all these investments need to start showing real returns. If they don't, valuations could take a hit. The second window is a little further out, 2026 to 2027. That's when we'd see a classic hardware bust if it turns out we simply built way more capacity than we actually needed. And that really brings us to our final thought. The dot-com crash was devastating for a lot of people, but the infrastructure it left behind became the foundation for Google, for Amazon, for the entire modern internet. So if this AI investment cycle does correct, the ultimate question isn't just about the money lost. It's about the incredible technological legacy that remains and what we'll all be able to build with it next.